Yes, good morning, viewers. I welcome you to today's session where we are going to analyze advanced financial reporting, which is paper 12 of CPA. As you're aware, this is one of the core papers for the qualification of CPA in Uganda. Your lead tutor for today is CPA Zed Muyingo, and I will be taking you through the key areas of the paper, of the subject, and most importantly, section A. As you are aware, in paper 12, section A accounts for 50%. Section A accounts for 50% of the marks. And for our paper 12, section A is purely defined. It is the group accounting. So as a candidate who is preparing to attack this exam come December, you must be well prepared for this section. Because if you can get at least more than 50% of the 50 marks, that is 25 and above, then your chances of making it through are very high. This is a section where at least everyone should be well prepared, because you go into an exam knowing that section A is purely group accounting. What you may not be aware of is whether the examiner will test you on consolidated statement of financial position, comprehensive income, or cash flows. But at least you know that it is group accounting. So in this session, I'll be taking you through this section and specifically highlight what are the key areas that I must know, what we call the must know areas for this section. In this debrief, our concentration will be on consolidated statement of cash flows. The consolidated statement of cash flows, which is IS 7. To give you a high-level summary for the topic of this debrief, our consolidated statement of cash flows are covered under IS 7. IS 7 is the standard on cash flows. Now, the cash flows take the same approach, whether we are dealing with the cash flows of a single entity or we are dealing with the cash flows of a group. So they take the same approach. This classification of cash flows, regardless of whether it is a single entity or a group, remains the same. Our cash flows will be classified as cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Those remain the classifications of cash flows, regardless of whether it is a single entity or a group. So the knowledge that we use in preparing cash flows is the same for single entity and group accounting. What changes is that there are additions. If I'm dealing with a consolidated cash flow, there are some additions. That is, in a consolidated cash flow, you will have dividends received from an associate. Dividends received from an associate. You are aware that an associate entity is an entity in which the acquirer owns or holds 20% or more of the equity shares, but less than 50%. So in an associate entity, the acquirer owns between 20% to less than 50%. Less than 50%. That is an associate holding. So because this acquirer, the acquirer is what you would call the parent. So this acquirer owns some shares in that entity. Therefore, the acquirer will be entitled to receive dividends. Now, this one is an addition in the consolidated cash flows. We don't have dividends received from associates when we are dealing with a single entity. Okay? Then you have the second addition that we bring in here is the net cash position. The net cash position. The net cash position. That when we're dealing with the consolidated cash flows, they will tell you the parent acquired is maybe 70% in this subsidiary. It paid maybe 2 billion. But among the assets it received the cash from this subsidiary. So if you paid 2 billion, but received the cash of say 5 billion on acquisition of that subsidiary, it means you have a net cash position of 3 billion as a net inflow. You paid 2 billion, but among the assets that came with that subsidiary, there was cash of 3 billion. That gives you a net cash inflow of 3 billion. Okay? One would wonder why an entity can pay 2 billion to receive 5 billion. Remember the forms of purchase consideration, where you can have cash, you have deferred consideration, you have share exchange, you have contingent consideration. So maybe as part of the purchase consideration, there was cash, 2 billion. There was deferred, maybe 7 billion. There was a contingent consideration, maybe 6 billion, etc., etc. That when you aggregate the purchase consideration, it is much higher. But in terms of cash flows, when we are dealing with the cash flow statement, we are looking at how much cash did you pay out and how much cash came as a result of the acquisition. At the same time, in consolidated cash flows, you can sell off a subsidiary. You can say during the year, the parent sold off this subsidiary X. When you sell a subsidiary, you get money. So you receive cash proceeds. So we can say you received the cash of 7 billion. This is an inflow. But this subsidiary that you sold, amongst the assets it had, maybe there was an asset called cash or bank. So whereas you received the 7, you might be losing, say, 4. I sold a subsidiary, I got 7 billion. But because I sold off this subsidiary, I'm no longer consolidating it. Therefore, I'm no longer consolidating its assets. And in those assets, there might be an asset called cash. So I now get the 7 that I received, I less the cash that I lost on disposal, giving a net position of 3 billion as a net inflow. So that net cash position is also an additional here in the consolidated cash flows. The other addition that we bring in here in the consolidated statement of cash flows is the dividend paid to NCI, which we don't have in a single entity. In a group of companies, there is a parent, there are subsidiaries, there are associates, there are mere investments. Where you have a subsidiary is controlled by the parent. But the parent may have control with a shareholding of 80%. That means the other shareholders, what we call the minority shareholders, own the non-controlling interest. And that is the 20%. Because they are also shareholders, they are entitled to a dividend. So the dividend that we pay to NCI holders is a cash outflow. And it's also an additional item when we are dealing with the consolidated statement of cash flows. You cannot find this in a single entity. In a single entity, you are dealing with one company. It doesn't have subsidiaries, there are no associates. Therefore, there is no dividend paid to NCI in a single entity. This we have in consolidated cash flows. So colleagues, these three additions create a difference between a single entity cash flows and the consolidated cash flows. And this is what I want us to look at today. If I'm dealing with the consolidated cash flows, how do I go about it? I am aware that this is a topic in consolidation where candidates find challenges. Why do candidates find challenges here is because unlike a consolidated statement of financial position, which follows a certain order, that note number 1 will be group structure, note number 2, net asset summary, note number 3, goodwill, etc. Here, when you're dealing with the cash flows, there is no specific order for arranging your notes. And that's why candidates find problems here. They get challenged here. But in this session, I want us to break down this topic. That in case you had challenges, if you have been experiencing challenges, I want this session to close all those knowledge gaps that you have about this particular topic. I'm going to share with you the question here. We run through it, and then we derive the appropriate solution. Before I share the question, I want to appeal to you candidates that prepare well for the final exams. As Matabacus has done, we have done our best. And we shall continue to do our best, as we have always done. Okay? These exams have been done before. You are not the first one. People have passed them. Don't be intimidated. There are no new questions being examined. The questions being tested are the same. What the examiners are changing is they are changing the scenarios, but the principles are remaining the same. Cash flows will be cash flows. What can change are the scenarios, but the principle remains the same. When you're approaching these questions for level 3, don't rush to start deriving a solution. First, read the question, understand it. Read the case, understand it. You're always given 15 minutes to prepare reading time. In those 15 minutes, don't rush to start writing. Read the questions, select your options, so that by the time they say start, you are ready. Candidates don't fail at execution. Candidates fail at planning. If you don't plan to execute, if you don't plan well, you may not actually make it. But if you plan well, during the 15 minutes, you need to have a plan that I'm going to start with this question, go to this question, go to this question. Stick to that plan. Follow the principles. I want you, if you're doing an exam, to always recall, what did the tutor say? What does the standard say? Because this paper is tested from standards. Stick to the principles, you will succeed. So I want to flash the question here so that we can start. Okay, let me get it here. All right, colleagues, I'm sharing a question here that I want us to use to dissect this topic of consolidated cash flows. So I've shared a question here which says that Porta Uganda was incorporated as a limited company specializing in production and the sale of construction material. Pool owns a number of investments, including subsidiaries and associates in Uganda, On 1st of June, Pool acquired 80% of the shares in Direma for a cash consideration of 11.2 billion. When Direma's value of identifiable net assets stood at 13.2 billion. As a strategy of diluting concentration in the construction sector, Pool disposed of 45% of the holding in Direma on 1st of October 2021 for consideration of 7.2 billion, when the fair value of the non-controlling interest in Direma stood at 2.9 billion and acquired 70%. So you can see the examiner initially had told us that on 1st of June, Pool acquired 80% in Dulf. That was 1st June 2020. But later, because they wanted to dilute concentration in the construction sector, they sold 45% in Dul, and this was on 1st of October 2021. Initially, they had acquired 80, but now they sold off 45%. Therefore, they remained with 35% holding. They moved from a subsidiary holding to an associate holding. After that, they said, and acquired. So after selling the 45%, they now used the proceeds to acquire 70% in what? In a tool. Tool specializes in plastics. You see, they are now moving up from construction sector to plastics because that is their strategy. They want to dilute concentration. They were over-concentrated in the construction sector. They are now moving into plastics for a cash consideration of 9.5 billion. After disposal, the remaining equity interest in Dul was fair valued at 5.5. The fair value of Tool's net assets at the date of acquisition stood at 11.1 billion. And the Pool as a group uses a proportionate share of net assets method to account for any goodwill arising on what? Acquisition. Remember, we have two methods of calculating goodwill: the proportionate share of net assets method and the fair value method. In this group here, they are using the proportionate share, what we call partial goodwill method. The draft consolidated statement of financial position for Pool Group for the year ended 31st of May 2022 is as follows. So they have given us the group statement of comprehensive income, and then they have also given us the group statement of financial position. You need to be very mindful of the years. We know that the current year comes first when you're presenting financial statements, but the examiner may change the arrangement. They can have 2021 here and 2022 here. So you need to be very keen here. Don't take it for granted that always the current year comes first. Okay? Then the examiner continues that this is the financial position. Then we have additional information that the following information relates to the acquisition of Tool and the disposal of Tool. The first column is Tool. Tool is the new subsidiary that we acquired. The second column is Dul, the subsidiary in which we sold 45%. So they have given us their net assets, their assets and liabilities. Okay. Note number 2 says an impairment test conducted at the start of the year, at the year end, resulted in full write-down of goodwill relating to Tool. When we say that goodwill was written down in full, it means it was fully impaired. So we shall have to calculate goodwill and then the resulting impairment. The impairment loss was charged to cost of sales. Remember, we are dealing with the consolidated statement of cash flows. In cash flows, we are looking at cash inflows and cash outflows. For an expense to qualify as a cash outflow, it must involve cash movement. Now, the examiner is pointing you towards impairment. We all know and we agree that impairment is an expense. As per accounting, it's an expense. But it doesn't have cash movement. when an asset is impaired, it does not mean that there has been money that has been paid out. Yet, yes, it is an expense, but which does not involve cash movement. So this expense was charged to cost of sales. By them charging it to cost of sales, it means our costs were overstated, and therefore the resulting profit was understated. Our work in cash flows is to recognize that. Recognize that as a cash outflow. How you will add it back, I will show you. While goodwill which arose on acquisition of Dul had not suffered any what? Impairment. So if the examiner is saying that the goodwill on Dul did not suffer any impairment, ideally one would think that there is now no need of calculating goodwill. Because when you are dealing with the cash flows and for the income statement, you only calculate goodwill if there is impairment loss. For the balance sheet, whether there is impairment loss or no impairment loss, you must determine goodwill, because goodwill is an asset. But for consolidated cash flows and consolidated comprehensive income, we need goodwill if there was impairment. Because for us on goodwill, what we need from goodwill is pure impairment. Okay? Pool values NCI at the date of acquisition at the proportionate share of the fair value of the acquiree's net assets and liabilities. The examiner had told us earlier that the group uses a proportionate method to calculate goodwill. I wish to remind you that the method we use to calculate goodwill is the same method we use to calculate NCI. If we have used the fair value method on goodwill, we must also use fair value method on NCI. If we use the proportionate share of net assets on goodwill, we must also use proportionate share of net assets in a calculation of NCI. Note number 3 says, during the year, Pool disposed of plant and equipment costing 2.4 after having been depreciated by 2.1. So you can see you had an asset that cost 2.4. It had depreciated by 2.1. That means its carrying value was 300 million. But this was sold off at a profit of 10%. So to get the disposal proceeds, we shall get the net book value times 110%, because we sold at a profit. And these were credited to cost of sales. We know that profit on disposal, even a loss on disposal, do not involve cash movement. Yes, in accounting, in IFRS, profit on disposal is profit, and therefore it is treated as other income in the consolidated comprehensive income. However, that income does not involve cash movement. The same applies to loss on disposal. It's an expense, but which doesn't involve cash movement. So those two items, profit on disposal and loss on disposal, should be de-recognized when we're dealing with the cash flows. And I will show you how we de-recognize them. Now, this profit on disposal was credited cost of sales. Because it was credited to cost of sales, it reduced our cost of sales. And because our cost of sales were reduced, it increased the resulting profit. Therefore, it means our profit is overstated by that profit on disposal, which we must do what? Eliminate. Pool also acquired right of use assets. Right of use assets, these are assets arising from lease transactions. When you enter into a lease to acquire an asset, you, the lessee, on your balance sheet, you create two items, a lease liability and the right of use asset. That is IFRS 16. Okay? So we also acquired right of use assets amounting to 2 billion. These were debited to property, plant and equipment. What that transaction is pointing you to is that in this arrangement, once there is right of use asset, there is also a corresponding lease liability. We shall see how to deal with it. The market value of plant and equipment increased, resulting in a revaluation surplus of 90 million, while the building suffered a revaluation loss of 1.5 million. The revaluation gain was credited to other incomes, while the loss on revaluation was charged to cost of sales. Again, revaluation gains and losses don't involve cash movement. Therefore, we shall have to derecognize them. Other intangible assets also suffered a revaluation loss of 175 million, which management charged to cost of sales. The depreciation expense for the year amounted to 245 million. Depreciation, again, is another non-cash expense that we have to recognize. The balance on other incomes relates to gains on financial assets at fair value through profit or loss. The financial assets are investments in quoted shares. They were purchased in 2020 using surplus cash, and they are designated at fair value through profit or loss, and they are expected to be sold immediately after the year end 2022. No dividends have been received. The same problem. Fair value gains or losses do not involve cash movement. So because they don't involve cash movement, we have to derecognize them. Included in trade and other payables is $102,000 payable to a foreign supplier who had not been paid by reporting date. This amount was invoiced when the exchange rate was $1 equivalent to 3,500. However, by reporting date, the shilling had depreciated by 5% against the dollar. The exchange gain or loss on the transaction have been included in administration costs. The same problem. Foreign forex gains or losses, if they are unrealized, do not involve cash movement. Here I'm translating a balance. They are telling me in my payables, there is a payable of $100,000. On that payable, they are telling me that payable arose when the exchange rate was $1 equivalent to 3,500. That was the exchange rate then. But now they are telling you that our shilling has depreciated against the dollar. When a shilling depreciates, it means it is losing, you can say it is losing value. It's now becoming more expensive to buy a dollar. That means if you have to buy a dollar now, you get 35 times 105%. This 5% is the depreciation. When a shilling depreciates against a dollar or any other currency, it means you now need more shillings to buy that foreign currency, 1 unit of that foreign currency. If this was appreciation, it would mean that I now need few shillings to buy 1 unit of that foreign currency. In that case, if it was appreciation, it would be 35 times 95%. The appreciation, the shilling is becoming stronger. The depreciation of the shilling, it means it is becoming weaker. You need more shillings to buy 1 unit of a foreign currency. Now, again, that foreign exchange gain or loss, this is a depreciation, which creates a foreign exchange gain, loss. That foreign exchange loss is not realized. The company has not suffered it because it is not paying at this point. It's a mere translation of a balance. It's a mere translation of a balance. Because it's a mere translation of a balance, that exchange loss is called unrealized foreign exchange loss. If the transaction was that we are paying, if they said we paid this $102,000, if you are paying and the exchange rate has moved, there you would get a realized foreign exchange loss, because it would mean that because you are paying at a higher exchange rate than the one you would have paid at. In that case, that realized foreign exchange loss has cash movement. And in that case, we would do nothing. don't derecognize. But when you're translating a mere balance, you are not paying, you have a payable, you have a receivable, etc. The exchange rate on those balances is unrealized. Okay? Required consolidated, prepare a consolidated statement of cash flows for pool group for their end at 31st May 2022 in accordance with IAS 7 statement of what? Cash flows using indirect method. So colleagues, there are two methods of preparing cash flows, statements of cash flows. We have indirect and we have the direct method. In this question, we are going to look at the indirect method, which is the common method. But it does not mean that the direct method is not examinable. It's also examinable, but indirect is common. In exams, even in practice, entities prefer the indirect method. Okay? So, how do we go about this particular question? As usual, we need to be organized. Organized, here we mean that what the examiner has requested us to do will come on the first page. So on page 1, we shall put the consolidated statement of cash flows. Then in the subsequent pages, we shall now put the notes to accounts. So we shall come here and say that this is pool group. The heading takes the name of the parent. In all this arrangement, the parent is pool. So we shall have pool group. Okay, you can put dash there. Consolidated statement of cash flows for the year ended 31st of May 2022. That is the heading. You must write a correct heading. A correct heading should have the following: the reporting entity, who is reporting pool group. It should have the financial statement. What is our financial statement here? Consolidated statement of cash flows. It should have the reporting period. What is our reporting period here? 31st May 2022. Then it should also have the currency. What is our currency here? We are reporting in Uganda shillings. You can say whatever we have is in millions of Ugandan shillings. That is our heading. And this should appear on page 1. If you're answering this in the finals, that should be your first page. Then you now go to the second page. On the second page, you now put the notes to accounts. Notes to accounts. Now, I'm calling it second page, but candidates, I advise you use judgment. Normally, when we are doing exams, we encourage that after every item in the financial statement, you keep on skipping a line so that in case there is something you have forgotten, you have somewhere to fix it instead of congesting the work. So you can realize that in the final exams, the consolidated statement of cash flows may not fit on one page. Okay? That statement may require 2 pages. So you reserve page 1 and page 2 for the statement. Then you put your notes to accounts on page 3. Now, at level 3, the notes to accounts, we don't call them workings. Okay? We call them notes. They are notes to accounts. Because we borrow from IS1 that a complete set of financial statements comprises of what? income statement, balance sheet, changes in equity, cash flows, and then the notes to accounts, or what we call explanatory notes. So don't call them workings. We call them notes. Okay? So we start with the note number 1. We start with note number 1. In group accounting, whether you're dealing with the cash flows, income statement, or balance sheet, the first note is called group structure. Group structure. How is the structure of this group? You go back to the question. If I take you back to the question, it is here. I can first remove all of this. And remember, we are looking for group structure. They say, on 1st of June, 2020, Pool acquired 80% in Dole. Okay? Then later, as a way of diluting concentration, Pool sold 45% in Dole, and this was on 1st of October, 2021. I start with that. I come here and I say that I have Pool and I have Dole. I have Pool and I have Dole. Initially, Pool had acquired 80%. You put 80% there. Then later, Pool sold 45%. I deduct 45% there. Then I remain with 35%. What is important here is to quote the date for the final movement in equity. When does it actually become 35%? It became 35% on 1st of October 2021. That's when the shareholding reduced to 35%. That is Pool in Dole. Then we continue. We are building a group structure. The examiner continues that and acquired. So after selling the 45% in Dole, they now acquired the 70% in a tool. Okay? When was that? That was 1st of October 2021. So I just come here and I say that this parent company here, Pool, after selling Dole, they now acquired shares in Tool. How much was acquired? 70%. When was this? 1st of October 2021. That is my group structure, in which I have Pool as a parent, Tool as a subsidiary, and now Dole is becoming an associate, because now what we have is 35% already. Okay? Now, the group structure is important because it helps us to know which subsidiary are we adding, which subsidiary are we deducting, are we subtracting. Once I have the group structure, I now know that Dole is no longer a subsidiary. Therefore, this one I'm going to do what? To subtract. Tool is a subsidiary acquired during the year. I know this I'm going to do what? To add. For new subsidiaries, you add. For those that are no longer subsidiaries, you deduct. Okay? We now go to our first page. We now start presenting. As I told you at the beginning, that cash flows follow the same classification. We start with cash flows from operating activities. So we come here and say, these are cash flows from operating activities. Cash flows from operating activities. Okay? we can underline this one. Cash flows from operating activities. And operating activities, we begin with operating profit. Operating profit is profit before interest and tax, PBIT. For me to get the profit before interest and tax, I go to the income statement. So I can take you to the income statement. Our consolidated income statement is here. You can see from revenue coming down, you have profit before tax. But remember, what we are looking for is profit before removing interest and tax. So for me to arrive at this profit here, I'm going to get profit before tax. Then I add back the interest expense. That will give me profit before interest and tax. Therefore, I get this figure here, which is the profit before tax. And then I add back interest expense. Interest expense is also called finance cost. So I get this 11 and add back the 149. Okay? So we come here and they say our profit before interest and tax is 11,303.8. And then on this one, we are adding back the interest expense, or what you call finance cost, which is 1490.5. When we add those two, we come to 12,794.3. That is our profit before interest and tax. Okay. Let me get some sheets here. After profit before interest and tax, we now add back a non-cash flow expenses. So you add the non-cash expenses. You add the non-cash expenses. These are expenses which don't involve cash movement. Do we have them? Yes. One of the expenses that we will not miss is depreciation expense. We read through the question together. Depreciation is a non-cash expense, which you add back. Where is depreciation? I now take you to the question. Depreciation is here from note number 4. They are saying the depreciation expense charged to the profit or loss is how much? 245. That is non-cash, you add it back. So I come here and I add back the 245. It is 245 million. Remember, our degree of precision is millions. Okay? We also saw we have impairment loss. Impairment loss. Impairment loss is also non-cash expense that we should add back. But now, our impairment loss was impairment loss on goodwill. This one we shall have to calculate. We shall have to determine. So in brackets, I put note. At this time, I don't know which note it is. I will find out. Remember, we are looking at how do I first earn those low-hanging fruits, get those marks, simple marks, before you go into the complicated things. Which other expense did we see, which is non-cash? There was a loss on revaluation. There was a revaluation loss. Let us see. Where is this loss on revaluation? If I take you back to the question, it is all in note number 4, where they are saying the market value of plant and equipment increased, resulting in a revaluation surplus. That's a surplus. While the buildings suffered a revaluation loss of 125. So I have this loss on buildings of 125. The examiner continues and like this. Other intangible assets also suffered a revaluation loss of 175. Colleagues, you see that? where I have highlighted. So I have this first loss of 125, and I also have this second loss of 175. So I can add the two to come to the total revaluation loss. So I can say, for my revaluation loss, I have 125 on the buildings, and I also have 175 on intangible assets. When I add this, I come to 300 million. That's a loss on revaluation. Okay? Non-cash expenses. We also saw under the last note that there was unrealized foreign exchange loss. Unrealized forex loss. Unrealized forex loss. I can take you to note, the last note. That loss is here from note number 6. Okay? Note number 6. Where the examiner said, included in payables is $102,000 payable to supplier. This is a payable. That means we have a liability to pay. This amount was invoiced when the exchange rate was $1 equivalent to 3,500. However, as at reporting date, the shilling had done what? Depreciated by 5% against the dollar. When a shilling depreciates, it means me as a company, I'm suffering a loss. Because it means if I am to pay, I pay higher than what I would have paid. Therefore, I have a loss. So to calculate that loss, you just come here and say, the depreciation is 5% times the amount payable, $102,000, times the exchange rate then. Okay? You get the 5% times the amount payable, or to make it better, you get 5%. 5% is the loss I'm suffering on this exchange rate here. Then times the amount payable, $102,000. Another person can first get what is the new exchange rate. The new exchange rate becomes a 35 times 105%. So you get the new exchange rate minus the old exchange rate. Whatever you get, you multiply with $102,000. Okay? That one is also acceptable. So when I calculate here, I'm seeing I'm getting a forex loss of 17.85. That is unrealized foreign exchange loss. But colleagues, if this movement was on a receivable, if it was me receiving and the exchange rate has increased, it would become unrealized foreign exchange gain, because it means if they are to pay me, they pay me higher, they pay me more than what they would have paid me. But now this time, it is us with the payable. We are the one to pay. If we are to pay today, we pay higher than what we would have paid earlier. So to us, it becomes a loss since we are dealing with the payable. Okay? And because I'm translating a balance, that payable has no cash movement. Therefore, you add it back. It's a non-cash expense. But if you are doing an income statement, it is an expense. Ideally, all of these qualify as expenses in the income statement. But in the statement of cash flows, they don't qualify as cash outflows. Those two things are totally different. Remember, financial reporting rests on two underlying assumptions: accrual and going concern. Here specifically, accrual. When you're preparing the financial position, comprehensive income, changes in equity, you use accrual. You recognize transactions as and when they occur, and not when cash is paid or received. Okay? And then in accrual again, you don't look at whether there has been a cash outflow. No. You look at whether ideally the expense has been incurred. And that is what is here. Okay. So those are the non-cash expenses. After adding back the non-cash expenses, then you less the non-cash income. Okay? So you will come here and say less the non-cash income. There are those incomes which don't involve cash movement. Ideally, it is income, but we did not receive cash. There is no money that came in. We saw some of these things. I remember we had a revaluation gain. We had a revaluation gain. This revaluation gain was on what? Was on plant and equipment. Plant and equipment. I can take you back. If I take you back, it was here, note number 4. The market value of plant and equipment increased, resulting in a revaluation surplus of 90. Ordinarily, we know that gains on revaluation do not go through the income statement. They go through OCI. But in this case, the examiner is saying that the revaluation surplus was credited to other income. You see, other income is part of the profit or loss. Because it is in other income, it means it is overstating my profit before interest and tax. Yet it doesn't have cash movement, so you deduct. So I will come here and I say, I'm deducting 90.95. No cash movement. Okay? I also saw under note number 5, this note here, where the examiner said the balance on other income is part of the income statement immediately after gross profit. That's where other income is. Relates to gains on financial assets, which are measured at fair value through profit or loss. Remember, in IFRS 9, there are those classifications: amortized cost, fair value through profit or loss, and fair value through CI. So for financial assets that you measure at fair value through profit or loss, their fair value changes go through the income statement. But those fair value changes don't involve cash movement. They are telling you that the balance on other income relates to those assets which are measured through fair value through profit or loss. Okay? Now, how much is balance? Remember, your other income is here when you go to the income statement. Your other income, I can remove this. Your other income is here, this figure here. But in that figure of other income, the examiner told us that we had credited there gain on revaluation, the 99.50. So I have to first remove that one because I'm only interested in the balance. So when I get 625 minus the 99.50, which was a revaluation gain, I remain with other income of 534.05. That 534.050 relates to fair value gain on financial assets. That fair value gain does not have any cash movement. So it's not a cash inflow. I come and deduct. I put here fair value gain on financial assets. How did we get it? We got other income total, which is 625 minus, we are holding 6 zeros, minus the gain on revaluation, which was 90.95. So we remain with 534.05. That fair value gain does not have cash movement, so you deduct it. Okay? Those are the non-cash incomes that I've seen here. After this, you now derecognize non-operating income. You now less non-operating income. Now, what is non-operating income? This is income, and we accept it is income, but which is not from operating activities. It is income which is from other activities, like investing or financing activities. It is income we accept, but not from operating activities. It is from other activities, either investing or financing. From the question that we have here, this income includes, one, they said there was a share of profits from the associate. If I can take you to that note, which is okay, which is ideal actually from the income statement. You can see it here. The one I have highlighted. The one I have circled. Share of profits from associates. It is income, but that income is not from operating activities. Okay? Because it's not from operating activities, we derecognize it from operating cash flows, take it to where it should be. It should be under investing activities. So I come here and I say, this is profit from associate. Profit from associate. How much was it? It was 845.4. That income is under investing activities. Another person can also argue that, again, this income does not have cash movement. If you argue like that, then that profit from associate will cross over and come under that section of non-cash incomes. That yes, it is income, but it doesn't have cash movement. That person is also correct. I want us to take a granular approach and we say, yes, it is income, but not from operating activities. It is from investing activities. We are getting this income because we invested in shares of some associates. We have a holding somewhere. That's why we are earning this income. So it's not operating, it is from investing activities. Also, I saw somewhere where we sold PPE, and that's under note number 3, which says during the year, Pool sold plant and equipment costing 2.4 after depreciating it by 2.1. The disposal proceeds were at a profit of 10% and they were credited to cost of sales. The same arguments that we had on profit from associate. When you sell an item of PPE, you get money. That money you have got is a cash inflow. That cash inflow is not from operating activities. It is from investing activities. Therefore, we derecognize that transaction from operating activities and take it to investing activities. Okay? Now, so how much were the proceeds? If you look at the question, they say the asset had originally cost 2.4, it had depreciated by 2.1, but we sold it at a profit of 10%. Okay? For clarity, I can come and show it here. You can say note number 2 is disposal. It is disposal of plant and equipment. It is disposal of plant and equipment. What are they saying? Original cost was 2.4. It had depreciated, that is accumulated depreciation, 2.1. Therefore, it had a net book value, or what we call the carrying value, of 300 million. But it was sold at a profit. Okay? So I'm adding a profit here. They said we sold at a profit of 10%. So you get 10% of 300, which gives you 30. Therefore, that means our disposal proceeds were 300 and what? And 30. Those are the disposal proceeds. Now, what was taken to the income statement is the total disposal proceeds. They took 330. In many questions, they will tell you it is the profit that was taken to the income statement, which should be the case. But in this case, what was taken was total proceeds. Therefore, it is the total proceeds that we have to recognize. So I come here and I say the disposal proceeds should move away from here. Disposal proceeds. You can refer examiner to note number 2. And these are how much? 330. They should move away from operating activities to go under investing activities. Okay? Now, if they had taken only the gain on disposal, in that case, we would derecognize the gain on disposal. Under non-cash income, if it was only the gain of 30, that is the gain they recognize, then that would come under non-cash income and we derecognize it. Why are we derecognizing it? Is that it is because you are comparing proceeds against a book value. Okay? So those are the adjustments. After this, remember we are still under operating activities. Then you now bring changes in working capital. You now bring changes in working capital. Don't forget, up there, we still have impairment loss. We haven't reported. We shall report it. Here, we are teaching a candidate how you can first earn the simple maths before you go into the complicated stuff. When we go to working capital, we are looking at current assets and current liabilities, except cash, bank overdraft, or high liquid assets. Any asset that the examiner has qualified as high liquid, you don't include. Because cash, bank overdraft, and high liquid assets will come as cash and cash equivalents when we are reconciling at the end. So we go to changes in working capital, current assets and current liabilities. These we get them from the balance sheet. Okay? And they form a note. Okay. They will form a note. So we shall come here and call it note number 3. Note 3. You can aggregate all of them and call that note working capital. We are putting all of them in one note to save time. And I encourage you, even in exams, put them in one note. We shall start with current assets. And our current assets, I see we have inventory. So inventory will come here as the first column. After inventory, I see we have receivables. They come here as the second column. After receivables, I see we have payables. Just a minute. Let me satisfy myself that we have all. Inventory, we have seen. Receivables, we have seen. Sorry, we have short-term investments. That's also under working capital, unless they have told you that those short-term investments are highly liquid, which is not the case in this question. So you bring those short-term investments and then lastly, you have the payables. We are putting them in one note to save time. You start with the opening balance. Balance brought down. For inventory, what is the opening balance? For receivables, what is the opening balance? The opening balances are here. Remember the first year, the first column is current year. Second column, previous year. Opening balance is this, that, and for payables, it is that. Those are the opening balances. So we come here and report. Okay. The opening balance for inventory is 221.6. For receivables, it is 2466. For short-term investments, it is 1649.6. And for payables, it is 1120. Those are the opening balances. On this, we add. Now, this is now where consolidation comes in. The principle is you add the subsidiary acquired, you less the subsidiary sold. Simple. Add the assets of the subsidiary acquired, less the assets of the subsidiary that we sold. Because you consolidate a new subsidiary, deconsolidate the old subsidiary. So we shall add acquisition of tool. Remember, the subsidiary we acquired is called a tool. On acquisition of tool, did the tool come with the assets? Among those assets, was there inventory? Were there receivables? Were there short-term investments? Among the liabilities that tool came with, were there payables? We now go to note number 2 of the question paper. So, sorry, note number 1 of the question. We are saying the following information relates to acquisition of tool and the disposal of tool. Okay? That on acquiring tool came with assets, which include PPE, intangibles, and the inventory. I'm dealing with working capital. So you can see tool hard inventory, tool hard receivables, and tool hard short-term investments. And also tool hard payables. So all of those I'm going to add back, to add. So I come here. In terms of inventory, the acquisition of tool came with inventory of 737.4. In terms of receivables, tool came with receivables of 715.6. In terms of short-term investments, they were 327 that tool came with. In terms of payables, tool had payables of 1857. You add the new subsidiary, you less the subsidiary that was sold. So I now come and less disposal now of DUL. When you sell a subsidiary, you also derecognize its assets and liabilities. You go back to note number 1 of the question paper. Note number 1. DUL is the second column. Okay? And the DUL was sold. When I sold DUL had inventory. That inventory, I did recognize. It had receivables, did recognize. It had short-term investments, did recognize. It had payables, did recognize. Okay? So I come here and I say, I'm derecognizing inventory, and that inventory is 848. I'm derecognizing receivables, which are 822.9. I'm derecognizing short-term investments, 377.5. I'm derecognizing payables, which were 1245. We derecognize them. Okay? So when you get opening balance, colleagues, and you add acquisition of a subsidiary, you less dispose of a subsidiary, what you get is what you call expected balance carried down. So here I will have my expected balance carried down. When I add my inventory, the expected balance is 2,111. When I add my receivables, my expected balance is 2,358.7. When I add short-term investments, my expected is 1,599.1. And my payables expected is 1,732.4. That is what I expect. I now compare this expected balance with the actual balance carried down. The actual balance carried down comes from the balance sheet. So you now go to your balance sheet, the actual for 2022. Because that is the balance carried down, you see the inventory is this. Receivables are those. Short-term investments, that. Payables, this. So you come and report that the actual balance carried down in terms of inventory, it is actually 1,487.9. In terms of receivables, my actual balance carried down is 1,757.6. In terms of short-term investments, it is 6,779.4. And the actual carried down for accounts payable is, remember, accounts payable has an adjustment. If I can take you there. This note number 6 affects our accounts payable, the actual balance carried down. They said the exchange rate the shilling had depreciated against the dollar. Because it depreciated by, I remember it was 17.85. It means our accounts payable are overstated by that depreciation of the currency of the shilling. So when I'm reporting the actual balance carried down for accounts payable, I'm going to take the actual of 1,464 from the balance sheet minus the foreign exchange loss, which will now give me 1,446.75. You remove the forex loss. So when I subtract, I now compare. Colleagues, let us interpret this. In terms of inventory, I expected to have 2.1. I have 1.4. I have lower inventory than what I expected. The assumption is your inventory is lower because you have sold some inventory. Okay? So the difference here is 6 to 3.1. And it's a decrease. You take a decision, you can say, I'm going to get expected minus actual. Or you can say, I'm getting actual minus expected. I advise us to use actual minus expected. You must be consistent. So I'm getting actual minus expected. So when I get actual minus expected, it becomes a decrease. It becomes a negative. So whatever you have as negatives will be decrease. Whatever you have as positives will be increase. Go to receivables, second column, actual minus expected. Again, it's also a decrease of 601.1. Go to short-term investments. For short-term investments, it's an increase. It is an increase by 180.3. Go to payables, actual minus expected. It is also a decrease of 285.65. We all know that a decrease in assets implies that those assets were sold and therefore money came in. So decrease in assets gives us a cash inflow. An increase in assets means we bought assets. That means money went out. That is a cash outflow. Increase in assets, cash outflow. Decrease in assets, cash inflow. For liabilities, if liabilities are increasing, it means we have borrowed more. So in terms of the cash, there is money that has come in. That's the cash inflow. When liabilities decrease, it means we have paid off those liabilities. That becomes a cash outflow. So the liabilities behave opposite to the assets. Okay? So I now come and report. I go to my cash flow and I say changes in working capital. I have a decrease in inventory. And my inventory is decreasing by 623.1. That means I have sold inventory and I got money. That is the cash inflow. I also have a decrease in receivables. That means, again, the assets are coming down. That means those debtors have paid me. That's why the balance on those debtors is decreasing. If they pay me, that is a cash inflow. I also have a decrease in payables. Now it is me paying, and the payables are coming down. That means I have paid them. Because I have paid them, that becomes a cash outflow. And then I also have an increase in short-term investments. Increase in short-term investments. My investments are increasing. That means I have paid out cash to acquire these short-term investments. That becomes a cash outflow of 5,180.3. Short-term investments. Their assets increasing. That means I have paid out money to acquire those assets. That becomes a cash outflow. So this is working capital. So you need now to reference your work. You tell the examiner that the changes in working capital are included under note number 3. So that it is easy for the examiner to go to that note and see what you included there. After this, you now bring interest paid and tax paid. So you bring the interest paid and also bring the tax paid. Those are cash outflows. Tax paid and interest paid. We do a note for them. It can come as note number 4. We can combine them. So you say, this is my note number 4, and that note is about taxation and interest. Whatever you have is in millions of Uganda shillings. The first column can be for taxation. The second column is interest. You start with the opening balances. Balance broke down. Tax normally, they will give you deferred tax and current tax. Where you have both deferred and current, you add the two and give us one figure. Look at the balance sheet. Our balance sheet is here. You can see in your liabilities, you have deferred tax here. And also you have current tax there. Where you have both deferred and current, you add the two and give us one figure. So I'm looking at opening balance. So I get this balance there for deferred plus that balance there for current. Okay? So I will come here and I say the opening balance for tax is both the deferred tax, which is 994.5, plus the current tax, which is 796.2. Members, you get it? Deferred plus current. Okay? So when I add those two, I am coming to an opening balance of 1790.7. That is the opening balance for tax. The opening balance for interest, again, it comes from the balance sheet. Interest payable is here. The opening balance, 874. So you come here and say, the opening balance here is 874.7. On this now you add, you now bring in consolidation. So we add, you add the new subsidiary, you less the subsidiary that was sold. So add the subsidiary that we bought is called tool. So you add acquisition of tool. When we acquired the tool came with liabilities. Among those liabilities, there might be a liability for tax and a liability to pay interest. So you go to that note number 1, which has acquisition of tool. And it's here, note 1, acquisition of tool. Tool is the first column. Amongst the liabilities, tool came with a liability called deferred tax payable and also had current tax payable. Those two liabilities. I add them to get one figure for tax payable. So when I come here, the tax payable on acquisition of tool, if I add those two figures, is 482.5. The same applies to interest. When we acquired the tool came with interest payable as a liability. You can see it here. Interest payable. 742.2. You come and add it here. 742.2. On this I less the disposal. So less disposal of Dul. When I sold Dul had liabilities. In those liabilities, there was a tax liability. This one here and this one here. I add the two and I derecognize them. So I come here and I say, when I disposed of Dul, I also derecognize those total tax liabilities, which are 1065. I also derecognize the interest payable. Dul had interest payable of 712. So I less it. You come here and you say minus 712. That is the consolidation now. You add a new subsidiary, less subsidiary, dispose it off. After this, you now add the expense for the year. The expense for the year. Is there a tax expense for the year? Is there interest expense for the year? These, you get them from the profit or loss. So during the year, how much is the tax expense? From the profit or loss. Our profit or loss is here. The income tax expense for the year is here. 3,475. The interest expense for the year is here. What they are calling finance cost. 1,490. So those expenses for the year, we add them. So I come here and I say, the tax expense for the year is 3,475, whereas the interest expense for the year is 1,490.5. I add. That is all. When I add these figures, what I get here is what we call the expected balance carried down. In terms of tax, when you add, you come to 4683.2. In terms of interest, when you add, you are coming to 2395.4. You now compare the expected balance with the actual balance carried down. The actual balance carried down comes from the statement of financial position. The balance sheet So when I take it to the statement of financial position, you can see taxes here. Again, you have deferred tax and you have current tax. You add the two and report one figure. Also, you have interest payable there. So those are the closing balances, which I come and report here. The actual carry down for tax, when I add deferred plus current, is 229.4. In terms of interest, the actual carry down is 1164. Good. We now compare. We are comparing. I expected a tax liability of 4. I have a tax liability of 2. I expected more than what I have. Where has the balance gone? Paid off. So I get actual minus expected. When I subtract actual minus expected for tax, I remain with 2453.8. This is what has been paid. It is paid because what is remaining is as actual is lower than expected. In terms of interest, I expected interest payable of 2. I have interest payable of 1. I have lower actual. That means I have paid off some interest. The difference between the two is 1231.4. That is interest paid. We transfer this to our statement of cash flows. Interest paid is 1231.4, whereas our tax paid is 2453.8. That is tax paid and interest paid. That marks the end of the cash flows from operating activities. But remember, there is an item we did not populate. What was that? That was the impairment loss on goodwill. So this impairment loss on goodwill will become our note number 5. Can we go and determine it? Note number 5, impairment loss on goodwill. Okay, so I come here and I say, this is note number 5. Which goodwill was impaired? Because that is what we need only. If you look at our question, they said from note number 2, an impairment test conducted at their end resulted in write down of goodwill in tool. So it is the goodwill of tool that is impaired, and that's what we have to calculate. So this is goodwill in a tool. Whatever we have here is in millions. For me to calculate goodwill, I start with the purchase consideration. Purchase consideration. When we were acquiring a tool, how much did we pay? Okay? You look at the question. From the beginning, they said, as a way of diluting concentration, we acquired 70% in a tool for a consideration of 9535. 9535. That is the purchase consideration. So I come here and report that we paid 9535.75. we are using proportionate share of net assets method. So that means on this ILS, the parent's share of net assets at acquisition. Remember, in tool, we acquired 70% times what were the net assets at acquisition of tool that have been given to us in this note here. They say the fair value of the net assets of tool at the date of acquisition stood at what? 11,122.5. So I come here and I say those net assets were 11,122.5. So when I calculate 70% of that figure, it gives me 785.75. Which I subtract from the purchase consideration, and when I subtract, I come to 1,750. 1,750 becomes the goodwill at acquisition. The examiner said that the goodwill in tool was fully written down. When you say fully written down, it means all of it was impaired. So that means the impairment loss. The impairment loss is 100%. Impairment loss, 100%. That means the whole of it, 1,750, is impairment loss. So it implies that in a tool, the goodwill carried down is nil. There is no goodwill carried down. It was fully written down, 1,750. That impairment loss is a non-cash expense. We go and add it in our consolidated cash flows, add it back. It doesn't involve cash movement. So note number 5, impairment loss, 1,750. There. I don't know whether members have seen it. Let me put it in red. 1,750. That is the impairment loss on acquisition of tool, the goodwill on tool. So we are done. So we now add from PBIT, you add the non-cash expenses, deduct the non-cash income, deduct the non-operating income, also include the changes in working capital, remove tax paid and interest paid. When you do the addition and the subtraction, the resulting figure becomes 5,379 plus 0.75. And this becomes the net cash flow from operating activities. The net cash flow from operating activities. It is a positive. That means it is a net cash inflow. Okay? After this, we now go to cash flows from investing activities. We now bring the cash flows from investing activities. What do we look at here? Here we are looking at non-current assets plus other income. Those are the cash flows from investing activities. Non-current assets plus other income. We can start with the low-hanging fruits. We have disposal proceeds from sale of plant and equipment. So proceeds from sale of plant and equipment. You remember the 330, which we said that this 330 is not income from operating activities. It is income from investing activities. I think it was not number 2. You come and report it there. I said start with the low-hanging fruits. Then we have a new subsidiary and we have a subsidiary that we sold. So you bring the net cash position. Okay? So you can bring the net cash position on acquisition of tool. When you acquired the tool, how much money did you pay against how much you received? That is the net cash position on acquisition of tool. Can we go there? Here we come. They said, we acquired 70% in a tool, and this was for a cash consideration of 9.5. You see it there? That is what we paid. So I paid 9.5, but tool came with assets. Among the assets it came with, there was an asset called cash. I now go to note number 1 of the question paper. Tool came with cash of 274. I paid 9.5 billion and I got cash of 274. So I net off. You also have to look at whether there was a liability, a bank overdraft. But here there was no bank overdraft. If there was a bank overdraft, you first get the cash that you got minus the OD, the bank overdraft. Then what you get, you compare with the amount that you paid. Okay? So I come here and I say, oh, okay. I come here and I say that on acquisition of tool, I paid out 9.5. Okay? And I got to 74. So I got to 74.5 minus what I paid, the 9,535.75. When I subtract, I remain with a net outflow of 9261.25, which you can say 0.3. I paid more compared to what I got as cash. I now go to the net cash position. Net cash position on disposal of Dool. When I sold Dool, I got cash. But I also lost the cash because now I'm deconsolidating Dool. Whereas I received the money, they paid me, but I'm also losing cash as an asset on Dool. Again, you come and look at it from here. They said, as a strategy, you sold 45% in Dool for a cash consideration of 7,200. So you got 7,200. But among the assets that you lost, there was cash on Dool of 315. So I come here and I say, I got 7,200, but I lost 315.7. I got more than what I lost. So the net cash position is actually a net inflow of 6,884.3. I got 7.2, I lost 300. So I have a net cash inflow. Okay? Those are low-hanging fruits and cash flows from investing activities. Once I'm done with that, I now go and test whether I have a dividend received from associate or I have acquired more PPE and any other non-current assets. Okay? So I'll now go to my note number, it will be note number 6. So note number 6, I bring a note called investment in associate. I'm trying to find out, did my associates pay me dividends? Let us see. Investment in associates. You start with the opening balance. Balance brought down as investment in associate. How much is opening balance? We get this from the balance sheet. Okay? From our balance sheet, investment in associate is a non-current asset, and you can see it here. Opening balance was 0. So you come and say opening balance is 0, nil. On this you add the new associates. During the year, did you acquire any new associate? Yes. The acquisition of that new associate is not direct, but it comes as a result of disposal. That initially we controlled 80% in Dul. Then we sold 45 and we remained with what? 35. That is an acquisition. It's a deemed acquisition. It is assumed that you sold off the previous subsidiary in Dul and you acquired a new associate in Dul. That associate was fair valued here. They are saying that after disposal, the remaining equity investment in Dul was fair valued at what? At 5.5. After becoming an associate, it was now valued at 5.5. That is what we bring here as a new associate, 5.5. On this, we add profit from associate. Profit from associate. This profit from associate comes from the income statement. During the year, did our associates pay us? Did we earn any profit on them? You look at the income statement, the answer is yes. You see that entry here. It is called share of profit from associate, 845.4. Okay, so it is 845.4. Remember, our degree of precision is millions. That is our share of profits from associate. Okay, after that you add. When you add, you come to 6,345.4. And this is what we call the expected balance carried down, which we compare with the actual balance carried down. Actually, how much is the balance carried down? The actual balance carried down comes from the balance sheet. And our balance sheet is here. The actual balance carried down as investment in associate is 5,650. 5,650. You come and report it here. 5,650. 650. That is the actual. You compare the two. I expected my balance to be 6. It is 5. I have a lower balance. That means these associates have paid me dividends. Remember, dividends are paid out of profits. If these profits were all retained, our balance should have been 6.3. But it means some of these profits were paid to me as dividends. And that is the difference. That difference is when you subtract, you see it is 695.4. That 695.4 is the dividend you received. So you get the actual minus the expected. And this becomes the dividend received. Don't say, why is it negative? As I told you, you can get expected minus actual. In that case, it will be positive. Or you can get actual minus expected. Here, we are not dealing with an issue of negatives and positives. I want you to analyze. I expected 6. I have 5. Why is it 5? It is because they have paid me a dividend. So that dividend received comes to our cash flows under investing activities. Dividend received from associate. And it is not number 6. How much is received from associate is 695.4. It is dividend received. It is us receiving. That's a cash inflow. Okay? Then I now test my non-current assets to find out whether you have acquired more non-current assets or whether you have sold some non-current assets. That becomes note 7. Note 7. Under note 7, I'm testing non-current assets. My non-current assets are coming from the balance sheet. My balance sheet is here. Among my non-current assets, I have PPE. I have goodwill. But goodwill, I've already seen that the movement in goodwill is because of impairment loss on tool. So there will be no other movement in goodwill there. Okay? Then I have intangible assets. They gave us something on intangible, we shall find out. And then we also have financial assets. Now, these are the assets we have to test here. We come here and we say, the first column will be PPE. The second column is intangible assets. And the last column is financial assets. We start with opening balance. Balance brought down. We get that from the balance sheet. For PPE, it is 26,556. For intangible assets, it is 1633.4. We may not even waste time with the financial asset because the examiner said here, we have a note about the financial assets. They say the financial assets are measured at fair value through profit or loss. And we discovered that that fair value change was 534, which should be the difference when you get this figure minus this figure. The difference between the two is 534. And that 534 was fair value change. So that means there was no acquisition of financial assets. So we can save time there. Don't include. After this, we add acquisition of tool. When we acquired the tool came with PPE, and that PPE was 1533.6. Tool also came with intangible assets, 647.5. Then you less disposal of Dool. When we sold Dool had the PPE of 17,633.2. Dool had intangible of 744.6. Okay? We move. After this, you remember there was a leased asset. You come and add it here. So you add that right of use asset. There is a note where they told us that during the year, we acquired right of use assets. I can take you there. Note number 3. They said, pool also acquired right of use assets of 2250. 2250. So it's what I'm adding here. Right of use asset 2250. Nothing under intangibles because it is right of use asset, you add it to PPE. Then we revalued these assets and there were revaluation gains and losses. So you add revaluation gain. From the question, when we revalued the PPE, there was a gain of 90.95. Okay? There was no revaluation gain on intangibles. But there was revaluation loss. So you less revaluation loss. The revaluation loss on buildings was 125. Buildings are under PPE. Whereas the revaluation loss on intangibles was 175. After this, you also less the depreciation or amortization expense for the year. The depreciation on PPE was 245. For intangibles, there was no amortization. After this, you less the disposals. During the year, did you sell any PPE? The disposals here should be at net book value. Did you sell any PPE? Yes. You remember plant costing 2.4 and having been depreciated by 2.1. Therefore, it means at the time of selling it, its net book value was 300. So it is that net book value that you deduct. There was no disposal of intangible. Okay? That is all. So you add and subtract, and you get the expected balance carried down. When I add, my expected on PPE is 25927.4, whereas the expected on other intangible assets is 1361.3. You now compare this expected balance with the actual balance carried down. This actual balance carried down is from the balance sheet. In the balance sheet, the actual carried down for PPE is 28,967.4, whereas for intangible, the actual is 1,960.8. Where are we getting these actuals? As I said, we are getting them from the balance sheet. The balance sheet is here. For PPE, the actual is here. The actual carried down. For intangibles, the actual is here. 1,960. So we go back and analyze. Look at this, colleagues. Start with the PPE. You expected your PPE to be 25. You have 28. Where have the other assets come from? You have bought them. That is the assumption. That the assets have increased because I have bought more assets. The increase there is 30/40. You get actual minus expected. So if the answer is positive there, it's an increase. If it's negative, it's a decrease. So again, but as I told you, it's not a game of negatives and positives. I want you to analyze. You have more assets than expected. Are they coming out of inheritance? The examiner has not said so. Were they donated? The examiner didn't say so. Therefore, where have they come from? It means you bought them ordinarily. When you buy assets, that's an outflow of cash. Look at intangibles. You expected intangible of 1.3. You have intangible of 1.9. Again, even intangibles are increasing. They're increasing by how much? By 599.5. It means you bought more intangibles. So these will be cash outflows. I come here and I say, I go back to my statement of cash flows and I say, I have acquisition of PPE. Acquisition of PPE. You can refer the examiner to note 7. I acquired the PPE and therefore I have a cash outflow of how much? 30/40. I have also seen that I have acquisition of other intangibles. Again, note number 7. I acquired intangibles to the tune of 599.5. 599.5. That is all I add and subtract. So we now look at the cash flows from investing activities. I get the 330, the proceeds, minus this, plus that, minus that, minus that. Only that section of investing activities. That section gives me net cash flow of 6,382 when I add, and it's negative. Because my answer is negative, we call that net cash flow towards investing activities. Because it is negative, that's why we call it towards. Because the first one from operating activities was positive, That's why we called it from. But under investing activities, I am spending more than what I'm receiving. So it becomes towards. Okay? And then the last category are the cash flows from financing activities. So I now bring the cash flows from financing activities. Financing activities. Under cash flows from financing activities, we are looking at equity plus the non-current liabilities. That's what we look at. Equity plus non-current liabilities. In other words, we're looking at the capital structure of an entity. A company is financed by equity and debt. That debt we are talking about is interest-bearing finance. That debt capital which bears interest. So here don't put deferred tax liabilities, because those don't bear interest. Okay? So again, we can start with the low-hanging fruits. It is simple to attack this section from the liabilities side. You look at the non-current liabilities. Let us look at them. Go to the balance sheet. The non-current liabilities are here. Oh, sorry. The non-current liabilities are here. You can see you have longer-term loans. You have longer-term lease obligations. Deferred tax is out. We have already accounted for that one under tax payments. Okay? Longer-term loans, longer-term liabilities. We can do a note for them. That will become note number 8. It will become note number 8. So I come here and I say note number 8. This is about loans and lease obligations. Loans and lease obligations. All that we have here is in the millions. Okay? The first column can be for loans. The second column is for lease obligations. I start with opening balances. Balance broke down. The opening balance for loans and leases will come from the balance sheet. For loans, it is here, 6.5. For lease obligation, I have this lease here. Pay attention here. I have this lease obligation there. And I also have this short-term lease here. Leases. So you get this longer-term lease here and the short-term lease here. You add them and report one figure. Remember, the splitting of leases is done out of best practice. But in other words, this is one obligation which will book as a longer-term liability. You do the same, you borrow the knowledge from deferred tax and current tax payable. So therefore, I come here and report my opening balances. So the opening balance for my loans, I will say, is 6.525. Whereas the opening balance for my lease obligation, when I add the two, I have 8938.4. On this, you add acquisition of tool. When you acquire the tool, did the tool come with the loans? Did the tool come with these obligations? You got note number 1 of the question paper. Note number 1 is here. acquisition of tool. Among the liabilities tool came with, there was long-term loan. You see it there? There were also leases. That long-term lease there and the short-term lease here. You do the same. You add long-term plus short-term and report one figure. So I will come here and I say, tool came with loans of 124.9 and also came with leases. When you add the two, tool came with leases. Just a minute, let me add here. Tool came with leases. If we add, okay, tool came with leases of 1532 plus short term, which is 174.5. 1532 plus 174.5, which will give us 1706.5. This is 1706.5. 1706.5. On this, we less disposal of dual. When we sold the dual had the loans, and the loans dual had were worth 3134. Those are the loans dual had. But also dual had lease obligations. If I show you the lease obligations dual had are here, 1463, and then we have the short-term lease of 4475. So I have 1463 plus the short-term lease of 447.5, which is 1910. So therefore, I come here and I say this is 1910.5. Those are the lease obligations that dual had. After this, I add. They said I acquired the right of use asset during the year. Because you acquired right of use asset, that right of use asset comes with a corresponding liability. And that corresponding liability was equal to the right of use asset, 2250. Remember from IFRS 16, right of use asset equals lease obligation plus direct costs plus initial deposit plus present value of dismantling minus lease incentives. So the others have been considered to be 0000. Therefore, right of use asset equals lease obligation in that case. Okay? After this, we add. When I add, my total loans become 9,820. And this is what you call the expected balance carried down. That is our total loan. Whereas our lease obligations are equal to 8938.4 plus 1706.5 minus 1910.5, then plus 2250. This one gives us 10,984.4. 10,984.4. Okay. We now compare this with the actual balance carried down. For loans from the balance sheet. Oh, sorry. I did not add well. For loans, when you add loans, you are coming to 5,515.9, which we now compare with actual, and the actual here is 9,820, whereas the actual liability is carried down at 10,067.65, which you can say 0.7. We start comparing. Start with the loans. You expected your balance on the loans to be 5. You have a balance of 9. That means you have acquired more loans to the tune of 4,304.1. Okay, actual minus expected. Okay, look at leases. You expected your leases to be 10.9. You have 10,067. Okay, you have a lower liability. That means for leases you have paid off 10,984.4 minus 10,067.7. So I have a balance of 9,116.7. So if the balance is positive, that is the inflow. If the balance is negative, it is an outflow. So the one is acquired, the other one is paid. If it is negative, it means you have paid. If it is positive, it means you have acquired. Again, I go back to interpretation. Just interpret the figures. Are you acquiring or you are paying out? So we transfer this. Loans acquired and then lease obligations paid. I come here and I say, I have loans acquired. We said this is note number 8. When you acquire a loan, that is a cash inflow. Then I have lease obligation paid. Still note number 8. When you pay a lease, that is a cash outflow. How much is the payment? 916.7. 916.7. It's a payment, therefore it's an outflow. Okay, we continue. Next, we now bring dividends paid to NCI. Dividends paid to NCI. Dividends paid to NCI, which is note number 9. We shall also have dividends paid to the parent. These are the ordinary shareholders, which we can also have as note number 9. Paid to NCI and paid to the parent. Okay, can come here and create note number 9. So note number 9, for me to get those dividends, I need 2 accounts. I need an account for retained earnings, and I also need an account for NCI. Those two accounts will give me dividend payments. So the first column is retained earnings. The second column is NCI. We start with the opening balances. Balance brought down. For retained earnings, these balances are coming from the balance sheet. So when I take you to the balance sheet, our balance sheet is here. The opening balance of retained earnings is here. That of NCI is here. Okay? So those are the opening balances, which I come and report here. For retained earnings, it is 5,512.4, whereas for NCI, it is 6,545. On this we add acquisition of a subsidiary. Acquisition of subsidiary. So you add the NCI on acquisition of tool. When you acquired the tool, you did not acquire 100%. You only acquired 70% of its net assets. So 30% of the net assets belong to NCI. I can take you there. They said you bought 70% of tool, but tool had net assets of 11,122. So you get 30% of 11,122. That becomes the NCI on acquisition of tool. And when you multiply, it will give you 336.8. On this, you less the disposal of Dole. When you sold Dole, you also did recognize the NCI on Dole. And the examiner said, at the time of disposal, if I can remove this, they said, you sold 45% in Dole for cash consideration of that when the NCI stood at 2,950. At the time of selling Dole, NCI was 2,950. You come and also they recognize it here. 2,950. They recognize. NCI should go to NCI, not to retained earnings. Okay? Okay. We move. After this, you now add share of profits. This is for the year. During the year, there were profits made. How much of those profits went to the parent? How much went to NCI? You can look at the income statement. That is where the breakdown will be. Profit for the year attributed to the parent is getting this, NCI is getting that. The one for the parent will come under retained earnings. So the share of the parent is 6,353.2, whereas the share that goes to NCI is 1,475.6. After this, I add. When I add, I get my expected balance carried down. In terms of retained earnings, my expected balance is 11,865.6, whereas expected for NCI is 8 407. I've rounded off. Good. I now compare this with the actual. How much is actual balance carried down? Which I again get from the balance sheet. From the balance sheet, the actual balance carried down for retained earnings is here, is 7, whereas NCI is also here. I come and report here that the actual carried down for retained earnings is 7240.5, whereas for NCI is 7068.6. I compare. When I compare, look at retained earnings. I expected a balance of 11. I only have 7. Where have the rest of the profits gone? It means they have been paid out as dividends. So the dividend paid will be 4625.1, whereas here the dividend paid will be 1338.8. These are dividends paid out. Dividends paid. Dividends paid. Now, for dividends paid, the expected should be higher than the actual. Or the expected should be equal to the actual. It is not possible that the actual can exceed expected. It means your computations have issues. Either the expected is equal to actual or the actual is lower than the expected. In that case, you have a dividend payment. If the expected is equal to the actual, it means there was no dividend paid. So I transfer these figures. Dividends paid to NCI, I have it as 1338.8. It's a payment, therefore it's an outflow. Paid to the parent, I have it as 4625.1. Those are dividends paid. Lastly, I test my capital. I test my capital. Look at share capital, ordinary share capital. Capital and premium, those move together. At the start, it was 10, it's now 11, it is increasing. Premium was 2.4, it's now 2.7, it's also increasing. Yet there was no share exchange. Remember, share exchange as part of the purchase consideration increase capital and premium. But now here there was no share exchange. That means during the year, we issued shares and got money. So what we do, you get this actual, you add the two, share capital and premium, minus the opening, again, share capital and premium. Okay? So add this minus this. So when you add the two, you will get proceeds from issuing shares. Proceeds from issuing shares. How much are they? I can see we have 1862.9. Those are proceeds from issuing shares. Because they are proceeds, it becomes a cash inflow. After that, you add financing only, this, that, and that. Let us see. So we have 4304.1 minus 916.7 minus 1338.8 minus 4625.1 plus 1862.9. We are coming to 7. We are getting 713.6. It's negative, and therefore it becomes net cash flow towards net cash flow towards financing activities. Net cash flow towards financing activities. So we now get operating plus investing plus financing activities. Those net cash flows, we now add them. The operating is here. Okay? Operating is there. Operating is there. We have it as 5379 plus 75. It's a positive. Investing is here. It's negative, so minus 6382. Then financing is here. It's negative, so minus 713.6. Okay, we are coming to negative. We have it as negative 1715.85. It is a negative, and because it's negative, we call it decrease. This is called decrease in cash and cash equivalents. Decrease in cash and cash equivalents. Decrease in cash and cash equivalents. Now on this you add the cash and the cash equivalents brought down. These you get them from the balance sheet. You get them from the balance sheet, where you get cash minus, in case there is an overdraft, from the balance sheet. So from the balance sheet, we do not have any overdraft, but our cash and the cash equivalents brought down is 5,2. Our cash and the cash equivalents brought down is 5211.55. 5211.55. So when I get one, okay, it's negative. So when I get 5211.55 minus 1715.85, I come to 3495.7, and this is what we call the cash and the cash equivalents carried down. That's what we call the cash and the cash equivalents carried down. So colleagues, that's how we deal with the consolidated statement of cash flows. The key takeaways are the classification of cash flows remains the same, like that of a single entity: operating, investing, and financing. The additions that we bring in the consolidated one are dividend paid to NCI, dividends received from associates, net cash position on acquisition of a subsidiary and on disposal of a subsidiary. I hope you will find this session useful to you as you prepare for your final exams. I once again thank you for listening to me, and thank you for choosing Matabaka's Business School. We thank you for entrusting us to walk with you your professional journey. We are more than willing to continue working with you your professional journey even next year. As you go and sit for your exams of December 2025, we wish you success. And we hope to see you again next year at the advanced levels. For this session, I want to stop here, and I say that God bless you.